Practical accounting, the better way to learn.
In our final segment for job order costing, we're going to introduce the before, during, and after and Fixit method for manufacturing overhead when it is over and under allocated. If you're following along in the sheets, these are the last two sheets in the file. And here we go. First thing, we're going to heavily use our one formula. Total cost is equal to average cost per unit times number of units. We're going to rearrange it to total cost divided by number of units equals average cost per unit. What happens with manufacturing overhead? And this is an over-allocated example. Well, remember, manufacturing overhead, we have a problem because we're not directly tracing things like the electric bill and things like that to the cost of the job. What we need to do is we need to allocate it or apply it. And the way we do it, because it would be pretty crazy to run out and read the electric meter every time you used a tool on a job, for instance. So what we're going to do is before we're going to establish this account called manufacturing overhead. And before the year begins or the period begins, the first step is before we're going to estimate how much manufacturing overhead we're going to have for all the different pieces for the entire year. And we're going to divide that by the estimated allocation base, which in this example, and it's commonly used, direct labor hours. Sometimes we use machine hours, which is the number of hours a machine is run in a process. But direct labor hours is often used as the allocation base because we know we're tracking that for sure. So the estimated manufacturing overhead in this example is $400,000. The estimated hours is 40,000 hours. So using our rearranged one formula, total divided by units equals average. Our estimated rate, also known as the predetermined rate, the estimated rate or predetermined rate is $10 per direct labor hour. So in other words, every time somebody works an hour on a job, we're, in addition to the wages, we're going to charge that job for $10 of overhead, manufacturing or factory overhead inside the factory to come up with the total cost of the job. So then we're going to take this estimated or predetermined rate of manufacturing overhead of $10. We're going to just use that. And we know that we had 1,000 direct labor hours in job 1, 2, 3, 4. So for body works. So job number 1, 2, 3, 4. So $10 times 1,000 hours equals $10,000 charged to the job. And this is our one formula again. So we're going to apply $10,000 or allocate $10,000 to job 1, 2, 3, 4, because we know we're already tracking direct labor hours to get that into the cost of the job. And we're going to use that $10,000 and we're going to total up how much it was totally put in. And the way it looks when it goes in, by the way, is we have work, that's a debit to work in process inventory and a credit to the manufacturing overhead account. This is transaction number 4 in the previous example when we applied our factory or manufacturing overhead. So we're going to now take a look, and if we had 10,000 from this job, let's say we had 490,000 from all the other jobs. So we have a total of $500,000, which has been allocated or applied or charged out of this account. And that would leave a balance over here on a T account in our manufacturing overhead of $500,000.
This might be a good time to take a little break. We have lots more to do.
Now, let's say when we look at the actual expenses, which would be charged as debits to the same account for supplies, etc. Let's say our actual expenses are less than that, $450,000. So that would be a debit to this manufacturing overhead accounts. So at the end of the period, certainly at the end of the year, but probably more often, we would take a look at this account and we'd find that there was a balance in here. This is a pass-through account, so we don't want to leave that balance there. And this means that we've over allocated, we've put too much cost into the jobs by $50,000, over allocated. So we need to get rid of that and close that account out. Otherwise, our financial statements will be incorrect. So there are two ways to do it. The simplest way, we're going to go down here. The simplest way is to close this account out by debiting manufacturing overhead, which is going to increase it. But most importantly, the credit here is to cost of goods sold. Okay, so this in this way, we're decreasing our expense because this would have increased it over what it should have been. So we're decreasing our expense and correcting our income statement and statement of retained earnings. And so this is an important adjustment and closing entry before you close the books. That's the easy way to do it, and it can be done if this amount is immaterial. Okay, but and by immaterial, it's off by less than this. This is well over 10%. So you would probably do the more complicated method, which is really not that bad. You take each job and say what percentage of the total allocated was allocated to this job. And so job 1, 2, 3, 4 was 10,000 divided by 500,000, and you would and then 98% to all other jobs. So you would reduce the cost of job 1, 2, 3, 4 by $1,000, and that way, and then let that flow through and other jobs, and the total change is still bringing it back down to $450,000. The other advantage of doing it this way is, let's say there's still some of these costs in work in process or finished goods inventory. This is why the materiality thing really is important, because you want to make sure that if some of this cost is still in inventory, that you don't charge it off the cost of goods sold. So it's not a surprise that this comes out to be a different amount, because remember, we have an estimate divided by an estimate up here. Either one could be off, and in this case, it is by a significant amount. So the debit, the adjusting entry again is debit manufacturing and overhead to close it out, and credit cost of goods sold to close it out, unless you're doing it by the job, and then you look and see whether this inventory is sold or whether these jobs have been sold and delivered or not, and then you would adjust it as individual accounts. So let's take a quick look what happens in the opposite. Everything in this example is exactly the same, except instead of our actual expense being $450,000 here in green, our actual expenses came in at $525,000. In this case, our total allocated was 500,000 again, but we would have a debit balance, which we mean we were under allocated in this example. We had not put enough cost into the jobs, So everything works the same, except now we're under, so the adjustments are going to increase the cost of the job. In this case, 2% of 25,000 adds $500 to the job, and everything else would work the same. Now let's take a look at the impact here. Remember, we have this balance of $25,000. To dispose of it directly to cost of goods sold, we would close it out, decreasing the manufacturing overhead account, and increase our cost of goods sold with the debit. This is the direct write-off method. Increase cost of goods sold debit, credit to as a closing entry, as a credit to manufacturing overhead. Again, that's only if it's immaterial. If it is a large amount as a percentage of the total, then we would go back and adjust the jobs down and close it out in that way. This concludes job order costing. And remember to look at this video as many times as you want, and good luck in learning job order costing. Our next module, we're going to be moving on to process accounting. If you want to learn more, come visit us at practicalaccounting.com.
The better way to learn. Stay on the bridge with us, Dr. Hillard and I, as we move to the next segment. You still don't need the stinking formulas. How about that? See ya.
You can get this Excel workbook and a whole lot more
Stuff for free at practicalaccounting.com.
See you there.